Next, coming to IAS 23 borrowing cost. So in this standard, we are going to discuss accounting for borrowing cost. Then first, tell me which items are included in the borrowing cost. So first of all, what is meant by borrowing cost? Borrowing cost is nothing but in general term we say it as what interest or cost incurred at the time of taking the borrowing or because of taking the borrowing is said to be a what borrowing cost. So generally it includes interest. Generally it include what interest expenses. So relating to the respected borrowing, and another one is relating to any finance charge created in finance lease and another one is any exchange differences created due to the changes in foreign exchange rates when we take the loan from the outsider. So the main question in this standard we are going to discuss whether the borrowing cost is required to be capitalized or considered as an expense. Whether that borrowing cost required to be capitalized or considered as an expense. Then before going to that, we have to know the one topic called as what qualifying asset. Qualifying asset. So what is meant by qualifying assets, sir? So qualifying asset is nothing but the asset which take some substantial period of time to get ready for its intended use or for sale. That is said to be a qualifying asset. For example, we purchase the land and we construct the building on that land, then that building will take some period. The building takes some period to for completion of the construction of becoming that building into the useful condition. Then that building is said to be a qualifying asset. For example, if we purchase the flat from the constructed apartment, we purchase the flat, then that is not a qualifying asset because after construction, in case of constructed flat, the plot is ready for usage. So for getting ready, no extra period is required. So that's why it is not covered under what qualifying asset. So qualifying asset means the asset which takes some substantial period of time to get ready for its intended use or for sale purpose is said to be a what qualifying asset. That is said to be a what qualifying asset. So here the question is so first of all, before going to the qualifying asset, before going to the IAS 23, whether IAS 23 applies to all or is there any non-applicability cases? Means yes. So there is a non-applicability cases. This IAS 23 is not applied, not applied to the so biological assets. So biological assets which are accounted as per IAS 41, that is nothing but what agriculture, and another one is inventories. So all inventories are not covered here. So, for example, inventories which are manufactured regularly on recurring basis are not covered here, are not covered because that is covered under IAS 2. For example, that party is a sofa trader and he get one order to manufacture customized sofa. He manufactured that customized sofa and sells it to the product. For manufacturing of that sofa requires some period. But that sofas are not manufactured by the party on a recurring basis or not on regular basis. He manufactured only for the purpose of specified customer. So it is covered under what? Qualifying asset. So if he is a manufacturer of the sofa, that is not covered here. Next, that is not covered here. Then the next question is, so what is the accounting for the borrowing cost? So before that, we have to know what is how to recognize. We have to know how to recognize. So generally, for recognition purpose, generally borrowings are classified into the two types. One is specific borrowing, and the another one is general borrowing. So here, specific borrowing means the borrowing taken by the party for purchase of specific asset. Like I took 5 lakh for purchase of a building, then that is said to be specific borrowing. I took 5 lakh for construction of the plant and machinery. That is said to be specific borrowing. That is said to be specific borrowing. In that case, which rate is considered? The rate of interest relating to the specific borrowing is considered. The rate of interest relating to the specific borrowing is considered. Then coming to the general borrowing, here which rate is considered? We have to consider weighted average rate of interest relating to the general borrowing. Weighted average rate of interest relating to the general borrowing. So weighted average rate of interest relating to the general borrowing is considered. How to calculate? I will discuss. Then next, so IAS 23 states that capitalization of borrowing cost should commence when all the following conditions are met. So the first one is expenditure of said asset is being incurred. That expenditure you have to spend. For example, if the interest not spent by the party during the year, no borrowing cost will be capitalized. And one more thing is the maximum amount of capitalization of the borrowing cost to the extent of amount of expenditure spent by the party as a borrowing cost, and borrowing cost being incurred activities that are necessary to prepare assets for intended use or sale or in progress. And another one is so how much amount of borrowing cost to be capitalized? For example, the amount spent total borrowing cost is around 55,000. Am I eligible to capitalize total 55,000 during the year or not? So then you need to check. Then how to calculate it? How to calculate? I will discuss. So coming to the rate of interest to be taken. When the funds are borrowed specifically to acquire the qualifying asset, the borrowing cost may be capitalized or those of actually incurred. Nothing but at the rate of interest of that specific borrowing is only considered. Less any investment income on temporary investment of the borrowing during the capitalization period. Okay, so for example, so just I will explain here. So Wilson received a 18% $18 million, so 5% loan on 1st January 2008 to finance construction of a new factory. As the funds were not all required immediately, Wilson invested 6 million in 2% bonds until 31st May 2008. Construction of factory began on 1st March 2008 and was completed on 31st December 2008. So it was started from the 1st March 2008 and was completed on 31st December 2008. We need to calculate amount of interest to be capitalized in respect of the factory as on 31st December 2000. So here the total amount borrowed is how much? $18 million. And we took the loan from on 1st January. So $18 million into 5%. So and that construction completed on 31st December. So So $18 million into 5%. So how much? So 9 lakhs. So how much? So 9 lakhs. 9 lakhs. Then, and the total amount is not invested, not utilized on construction. Some part is invested. So how much amount invested? $6 million. Then we get some interest. So $6 million into 2%. That interest income received. That interest income received. So for how many months? Until 31st May only we received. In January, February, March, April, May. Only we received for 5 months. So then $6 million into 2% into 5 by 12. So $6 million into 2% into 5 by 12. So 2% into 5 by 12. So how much amount? So total how much amount? 50,000. 50,000. This is what borrowing cost, and this is what income received. Income received. So shall we capitalize this amount? What is meant by capitalization? We add back the borrowing cost in the cost of the respected asset. Shall we capitalize this whole amount to the added to the cost of the asset? No. So out of the total 9 lakh we spend, so we need to check. One thing. So how much amount spent by the party during this period? So 1st March 2000 x82, 31st December 2000, because the construction starts from 1st March and ends on 31st December. So we need to provide for this month only. Means how many months are there? So March, April, May, June, July, August, September, October, November. So how many months are there? 9 months. So we need to provide it only for 9 months. So we need to provide it only for 9 months. So 9 months only consider. 9 months only consider. So actually we took the loan on 1st March. Actually we took the loan from 1st March, so 1st January, and the construction completed on 31st December. So generally we need to calculate, we need to provide the interest for the whole year. But out of the total interest, how much interest is required to be capitalized? We need to capitalize only from 1st March to 31st December. Sorry, January, February is not. So 10 months. 1st March to 31st. So 1st March to 31st December is only considered. So out of this 9 lakh, this 9 lakh is meant for 12 months. Then what is the amount for 10 months? So 9 lakhs into 10 by 12 equal to how much? 7,50,000 is required to be capitalized. But out of which income earned. Here we earn the income of 50,000, and this is only for the period 1st January to 31st May. 1st January to 31st May. But out of that, we have to consider this period of income only. So then 1st March to 31st May is only considered, because till 31st December, we didn't receive the interest, right? So 1st March to 31st May is considered. So how many months? March, April, May, 3 months interest. So 50,000 into 3 by 12 is considered. So 50,000 into 3 by 12. So how much amount? So 12,500. So we have to provide the interest for how many months? Actually, we receive the interest for how many months? 5 months. So 5 months, right? So 5 months means January, February, March, April, May. So these 5 months only. Out of the 2 months are not considered. Out of the 2 months are not considered because January, February, during the January and February, we didn't start the construction. So we need to provide we need to consider the interest income only for 3 months. So that's why. So, or you may calculate in this way: $6 million into 2% into $6 million into 2% into for how many months? 3 months. So 3 by 12. So sorry, 30,000. So how much? 30,000. Then the remaining amount is 7,20,000 is capitalized. Then we write the entry for this. So debit PPE. Sorry, credit cash or bank account. So how much? 7,20,000. Debit PPE, credit cash or bank account. Okay. So how much amount is capitalized? In case of a specific borrowing, the amount of interest expended during the construction period less any temporary income received on the investment relating to that borrowing. So that amount required to be capitalized. Then we write the entry debit PPE, credit, cash or bank. And remember, we have to consider only construction period and any pre-construction or post-construction period borrowing cost is there. Those are not capitalized. So that amount is not capitalized. The total amount spent here 9 lakh minus 50,000. 9 lakh minus 50. 8 lakh 50,000 is the total amount, right? So out of that 7 lakh 20 is only capitalized. Then whatever the rest of the thing 1 lakh 30,000 is that amount is expensed. Nothing but transfer to profit and loss account. Nothing but transfer to profit and loss account. Then, in case of the general borrowing, we have to consider what weighted average cost of general borrowing is taken. Weighted average cost of general borrowing. So, how to calculate? So, here, if an entity had $10 million 6% loan and $2 million 8% loan. So, then we calculate. So, here, what is the borrowing amount? So $10 million and $2 million, total $12 million. Then what is the amount of interest? So here 6%, here 8%, right? And this is the rate of interest, and the amount of interest is 10 into 6%. So 10 into 6%, nothing but 0.6. So 2 into 8%. Nothing but 0.16. So total 0.76 is the total 0.76. Then individually for $10 million, what is the amount of interest? 0.6. For $2 million, 0.16. Then total interest 0.76 for how much amount of borrowing? $12 million. Then what is the rate? Then 0.76 by 12 into 100. So 0.76 by 12 into 100 equal to 6.33%. 6.33%. Or we may apply this formula. Okay. So borrowing amount and rate of interest individual. Calculate individual amount of interest. What is the whole amount of interest relating to the general borrowing? The total interest by total borrowing into 100. Then we get what? Effective rate of interest relating to the general borrowing. We call it as what? Weighted average rate of interest. And that is applied only for what? General borrowing. Then cessation of capitalization. As we already discussed, that capitalization of borrowing costs must be done through during the construction period. And once the construction is completed and once the respected asset came into the available for utilization and any amount spent after that period is required to be expensed. Expensed means transfer to profit and loss statement and not required to be capitalized. So capitalization of borrowing cost should be ceased, means what? Stopped. when either substantially all activities necessary to prepare the qualifying asset for its intended use or sale are completed. Means that construction was completed and the asset came to available for utilization. The construction is suspended, stopped due to the industrial disputes. So in these cases, we have to stop the capitalization and any amount spent will be transferred to profit and loss statement. Any amount spent is a transfer to a profit and loss statement. Okay. So here on 1st January 2000 expire, so Synisco began to construct a supermarket which had an estimated useful life of 40 years. If it purchased a site for $25 million, the construction of the building cost $9 million and the fixtures fittings cost $6 million. The construction of supermarket was completed on 30th September 2000 expire. It was brought into use on 1st January 2006. Synisco borrowed 40 million on 1st January in order to finance this project. The loan carried rate of interest 10% per annum. It was repaid on 30th June 2000 expire. 30th June 2000 expire. So calculate total amount included in the cost of PPE in respect of development on as 31st December 2000 expire. So here, the total amount spent for bringing that asset into the available for utilization is added to the cost of the asset, right? So which items are included? First of all, site. For construction, for purchase of the site, how much? So $25 million. And for construction of the building cost, how much? $9 million. And fixtures and fittings, how much? $6 million. And then verify any borrowing cost required to be capitalized. First of all, it is a qualifying asset because construction will take some period to bring that asset into available for utilization. So it is a qualifying asset. So we need to calculate how much amount we borrowed, $40 million. What is the rate of interest? 10%. We took the loan from 1st January 2000 expire and on the same date the construction was started. So we will calculate the borrowing cost from this day onwards. And that construction completed on 30th September 2000 expire. Nothing but for how many months we need to calculate the borrowing cost, which is required to be capitalized? January, February, March, April, May, June, July, plus September. Nothing but what? 9 months. So till 30th September, incurred borrowing cost is only capitalized. After 30th September, how much amount you incurred? That will be transferred to profit and loss as statement. So 9 by 12. So $40 million into 10% into, so 9 by 12 equal to 3. That is what borrowing cost. So that is what borrowing cost. So 15, 40, 43. 43 is the amount. 43 is the amount required. $43 million is required to be considered. Then we write debit PPE, credit bank. How much amount? $43 million. $43 million. Okay. So this is about what? Borrowing cost.